A crisis. Bank reserves are plummeting to a 5-year low. The emergency repo facility soars to a record $20 billion, and SOFR spreads are blowing out above the discount window rate. Is the Fed losing control? And what is their next move? So, as we can see, the standing repo, the Fed's emergency liquidity backstop, which was made permanent back in July of 2021, today's data came in and it is a record $20.3 billion. This is a record usage for the SRF. Remember what that is. When the banking system is short on cash, they go to the Fed, they provide the Fed with maybe mortgage-backed securities or U.S. Treasuries, and in exchange, they get cash. This is the facility to be used when there is a shortage of liquidity, and as we can see, is been increasingly frequently used over the past couple weeks, as of course SOFR spreads have been elevated. Here, by the way, are the results directly from the Fed. We can see the vast majority of this $20.3 billion today was in mortgage-backed securities. And here, by the way, we can see the Fed made this a standing facility back in July of 2021. Now, we've also been covering SOFR spreads for the past, going back to July or August, and I wanted to give an update on that. So down below, we can see these standing repo facilities since it was made permanent. We can see $20.3 billion needed to be tapped. The banking system is severely short on cash. Now, it is the end of the month, and there are elevated funding stresses at the end of the month, but this has been a crisis that has been building for arguably 3 months now, and we have been exhaustively covering it ever since. But we can see that the moving average, for example, the SOFR minus reverse repo award rate, that moving average continues to go vertical. In fact, SOFR for today, the most recent data, is now 30 basis points above the reverse repo. Now, of course, this also coincides with an increasingly frequent standing repo usage, which is denoted by the green line. And of course, the blue line marks quarter end, which is generally when you see that significant funding stress. Generally, month end, you might see some, but the vast majority of that funding stress is, of course, quarter end. And as we can see, SOFR has been blowing out. And again, what that represents, the secured overnight funding rate, what that means is that in the $3 trillion repo market, we have been seeing an increasing shortage or scarcity of dollars willing to be lent out. There might be dollars in the banking system, in the repo market, in that $3 trillion repo market, but if they're not willing to be lent out due to maybe counterparty concerns, then of course you get an elevated SOFR, right? If you are the only firm on Wall Street that has any cash and everyone is coming to you to ask for cash because they need it for window dressing or whatever day-to-day operations, you get to set a very high price. Well, that is SOFR. The price of money is that SOFR interest rate, and that is relatively free market supply and demand sort of derived instrument, not like the Fed uses. Now, IORB, discount window rate, reverse repo, of course, we got a Fed rate cut yesterday, but we still see SOFR above the discount window rate. Now, again, very briefly, the reverse repo, this is the Fed's way, a static interest rate. As you can see, it doesn't move except when they cut interest rates. That reverse repo award rate is the Fed saying no matter how overabundant dollars get, we will always buy them at that interest rate, at that price. And the discount window rate is setting a ceiling, saying no matter how scarce dollars get, we will always sell them. Right now, that interest rate is 4%. Well, as we can see, SOFR is at 4.04, 4 basis points above the Fed ceiling. And it's not just one day. As you can see, this was a common theme that we were highlighting back in mid-October. Here are all the dates over the past couple weeks, past 2 weeks, where SOFR, that actual market-derived supply and demand for these overnight dollar loans, the actual interest rate has been above the Fed ceiling. Now, this is an indicator, as I noted yesterday and in all the prior videos that we have done about this. I keep noting that if SOFR remains above the discount window rate, that is a sign that the Fed is losing control over the cost of capital, over the price of money itself. Remember, this overnight interest rate is the price of money. That is the price of a dollar. And of course, the Fed might be losing control. So I wanted to show this chart. TradingView is still not updated some of the data, so I manually did it in Excel. And here we can see all the days that SOFR has been above the discount window rate. Now, generally, of course, you want SOFR, the overnight cost of capital, to be within the range. But as we can see, it is increasingly not. Over the past 4 days in a row, SOFR has been above the discount window rate. And here, by the way, is the 99th percentile of that SOFR RRP spread. Again, I did this manually in Excel. We can see that it just blew out to a record. And the other thing I want to highlight is that the unsecured side, so SOFR, of course, being secured overnight funding, about $3 trillion, the much smaller Fed funds, which is unsecured, that rate has been ticking up as well. It increased 4 basis points over the past month. And of course, we got a 25 basis point cut. But generally, the Fed wants that Fed funds to be in between IORB, or interest on reserve balances, and the reverse repo, which again is the Fed's way of setting a floor in the price of money. They want the Fed funds to be right in the middle, just like it was for this period of time in, say, early 2025. But what we have started to see recently, as we can see denoted by the purple line, is that it has been ticking up relative to that floor. And in fact, it's getting dangerously close to IORB. In fact, right now it is only 3 basis points below IORB, which for the Fed funds is the ceiling. So the Fed uses IORB as the corridor for that unsecured Fed funds rate in white. And of course, discount window rate is supposed to keep an overall ceiling for things such as SOFR, and it is not working. It might be working for the Fed funds and the unsecured market, but it is not working for SOFR. As we can see from the prior chart, 4 past days in a row have been where SOFR has been above the discount window rate, or the Fed ceiling. And of course, this has coincided with a plummeting bank reserve balance. So last time this was updated, it was about 2.9 trillion. Well, it just plummeted even further, now down to 2.8 trillion. Now, there's a concept known as lowest comfortable level of reserves. No one really knows exactly where that level is. It has been estimated to maybe be around 2.7 trillion. And I had pointed out, we've been covering this exhaustively for like 3 months now. And in one of my earlier videos, I pointed out that the last time that bank reserves as a share of the M2 money supply, of course, which is you're looking at narrow money as a share of broad money, which is what we're looking at here, I noted that the last time that this got to 13%, we had some regional bank failures. In fact, here I will play that clip from the video that I did about 1 month ago. Last time we had bank reserves down at 13% of M2 here was January of 2023. Well, what happened? Very shortly after, the regional banks failed. We had 3 of the 4 largest bank failures in U.S. history happen just a couple weeks later. And I want to point out, of course, we have had regional bank issues very recently. Here is Zions Bancorp and Western Alliance. Now, maybe this is just a lucky coincidence, but if we go back to this chart, we can see that bank reserves as a share of the M2 money supply has in fact broken that 13%. So the pink lines represent 19, 16, and 13% relative share. And of course, the last time bank reserves got down to 13%, as I noted in that clip a month ago, we had regional bank failures. Well, the regional banks, at least these 2, are not doing very well at all. And I want to just point out that this has coincided with an increase in that SOFR spread. So if we zoom out a bit here and look at the increase in, this is the inverted SOFR RRP spread, we can see a pretty good correlation where as SOFR has become elevated, we can see a decrease, a sharp leg lower in these two regional banks. Now, is it entirely causal? Probably not, but I do think it's interesting that we basically nailed that call, a warning about issues with banks. And I'd totally forgotten about it until earlier today when I noticed that bank reserves as a share of M2 were just 13%. And I do also want to point out the correlation clearly here between bank reserves and that SOFR RRP spread. As you can see, the repo rate crisis where dollar liquidity got extremely scarce back in 2019 and SOFR spiked like 900 basis points above the Fed funds. That was in a period of time where the Fed was engaged in quantitative tightening, and of course, bank reserves had been falling. Of course, because here we're looking at inverted, so the green line going up means bank reserves had been falling. Eventually, that led to the repo rate crisis, very similar to what we're starting to see recently with SOFR spreads and, of course, the standing repo facility. So what is the Fed going to do? Oh, and also SOFR being above the discount window rate for 4 days in a row. This is highly, highly unusual and a sign that the Fed is losing control. Well, Fed Logan had some comments out earlier this morning, and I thought that they were very interesting. Of course, we had Jerome Powell yesterday mention the repo market stress and SOFR, which viewers of the channel were probably quite excited that they actually understood what he was referring to there because we've covered this so exhaustively. But I want to highlight four of these comments that that Logan made earlier today about SOFR stress and the repo markets and said, I'm disappointed to see tri-party repo rates exceed the SRF rate. Dealers may need to step up their readiness to access the SRF. Again, that's that emergency liquidity backstop. The size and timing of asset purchases shouldn't be mechanical. And finally, that IORB spread is a central indicator of reserve supply. And of course, that is backed up by the data we have. We don't have tri-party interest rates. We just have SOFR here with TradingView. But that is very clearly backed up by the data, as we can see that inverse correlation between SOFR RRP, especially moving average, because there's so much volatility day to day, that moving average and bank reserves inverted as SOFR over the RRP, that difference, that delta, that gap, as it grows wider, of course, that means bank reserves almost perfectly one-to-one correlation. Bank reserves are falling. We can see, in fact, even the spikes here are inversely correlated back in late 2024. So the Fed would probably be forced to restart QE balance sheet expansion. Fed rate cuts are not the answer to the sort of issues that we're seeing, this liquidity scarcity. Just like back in 2019, the answer was to increase bank reserves and to increase liquidity. You might get marginal benefit from a 25 or even 50 basis point emergency intermediate cut. You might get marginal benefit from that, but really what you need is an injection of liquidity. Bank reserves up, and again, those get injected into the banking system by the Fed buying U.S. Treasuries, mortgage-backed securities from the banks. So now the banks have freshly printed dollars, and of course now the Fed and their balance sheet has increased because the assets on their balance sheet have increased. But again, I don't think it's a coincidence that we have started to see issues with the regional banks. Of course, this was the top, and as you can see, the reverse repo SOFR spread started to widen pretty dramatically after that. They are definitely not unrelated. Whether or not it's 100% causal sort of link, I'm not sure. Probably no one really knows except the insiders at these banks. But I did think that it was an interesting thing to point out. So anyways, hopefully that was helpful. Of course, we'll continue to watch all the developments. We've been covering this so exhaustively. It's become almost a theme of the channel. We'll continue to watch it. And hopefully that was helpful. Probably explains why we're seeing some weakness today in the S&P 500 and in risk assets. It makes kind of perfect sense. We've warned about this before, the correlation with spikes in the VIX or downside in risk like the S&P and elevated SOFR spread. So again, this matters short term. Once the Fed comes in to inject the liquidity, risk should rebound quite sharply in that kind of V reversal. That is generally the view, at least that we have, of how this might unfold over the next couple weeks. So anyways, hopefully that was helpful, and I'll catch you in the next one.